Okay, welcome back, everyone. Final panel of the day, and it was going to be just our moderators, but we have moderators and guests, as unfortunately two of our moderators couldn't stay with us today. So delighted to have Michael Stahl back from LGT, Alex McCann from PCS, Joe Soroka from Fermat, and also delighted to have Mike Millett from Hudson Structured Capital Management. It's a pleasure to have you all with us. So, very good day so far, some really good discussions on stage, very interesting topics, and a good mix of exuberance, but perhaps not as much exuberance as I had expected after 2023. But I guess that's reflective of the fact raising capital is still not as easy as it was in the space for lots of good reasons. And investors require a lot of comfort to allocate to certain products within the space still as well. But I guess it'd be interesting to start with your thoughts on flows, and I've had a number of people come up to me today, some of them end investors, some not, all asking, are the flows going to erode the opportunity, and how much, and how disciplined do managers and also cedents and brokers and intermediaries all need to be this time to sustain an opportunity for the ILS investor going through 2024 and perhaps even into 2025. And maybe we could start with Mike Millett, as you haven't had a chance yet today.
Oh, sure. It was a remarkable year after 6 very difficult years. And it was remarkable in 2 different ways. There was a terrific experience in CAT, and there was an amazingly orderly launch of a whole new sector in cyber. So that was terrific. So what will happen as a follow-on? The CAT renaissance was very, very local. It occurred above 40, generally well above $50 billion in attachment points, however you cast those, whether they're PCS or so that worked. That's kind of worked for a few years now anyway, but that really worked this year. In fact, I suspect it'll work even better over the past few years once PCS thinks more about their Ian loss estimate. So that was great. We do see a lot of capital coming into that part of the space. Rates are already down from a year earlier. Rates will be down as we go forward based on what we're seeing. The good news is there's a lot to do. First of all, there's a big space below 50 billion attachment. It's a dangerous space because that did not have a clean year at all, but there's actual need there, and we think a lot about how to address it. And secondly, we have a whole new sector, the cyber sector. So those are some thoughts on flows.
Joe, one thing I would have asked you in the last session, I didn't have a mic, so I couldn't ask you a question, but I was interested to hear, talking about flows and things like that, obviously your panel spoke about how they educated the investor base. That was largely managers they were educating to a degree. But how did you educate your end investors about cyber, and how challenging was that?
Yeah, we've been talking to so we sort of identified cyber as, a hallmark peak peril quite some time ago at Fermat. We've been thinking about cyber now before I even joined. I've been at Fermat for nearly 7 years. So since I've been at Fermat for 7 years, we've been monitoring the space, waiting for this moment to arrive. We knew it would happen eventually. It was precipitated by ransomware. I think that really opened people's eyes in terms of the risk and the fascinating response that the cyber market had to the ransomware event in terms of re-underwriting the books, the rate, the wordings. And so that, I think, triggered where we are today. So we've been speaking to our end investors for over 2 years, 3 years, I think, that cyber would eventually make it into our portfolios where it's allowed. In our commingled funds, we do have an other bucket, and that's where it sits right now. Mm-hmm. So we spent a lot of time talking about it, and when we actually did start investing, not a single investor said anything. And in fact, after the Q4 that we've just had, we had investors reach out to us wanting to know more in a good way. Like we're investing in the cybersecurity company here. How is that related to what you're doing here? And I think what we found is really not a lot of pushback from our end investors. I think a lot of them are investing in equity, they're investing in corporate debt. They know that cyber is a risk for these companies. It's a harassing risk. They're taking that risk. They're probably not being compensated for it there. And the solution to that problem, that this harassing risk these companies are experiencing, is insurance. And then here is another asset class that they can get exposure to that's solving that problem, where we believe they're being compensated for that risk explicitly. So it's been actually a very positive experience with investors to date, and we will continue to do that, and we're committed to it. But yeah, we were surprised at how investors got the reason for this and the need for this capital.
I think the whole cyber experience has been very positive in terms of an example of how to keep investors appraised of a new development that's coming. I think that was clear from the last panel. It was very interesting to hear sort of how much effort goes into that. And it's sometimes perhaps something that we need to do more of in the cat space as well, and perhaps even explaining what attachments mean and how the new reality, how events would affect your portfolios in the new reality versus the old reality. There's quite...
Well, the other thing I just to say, Mikey didn't mention it, but these 4 bonds and cleared the market at a pretty hard market. There were concerns whether the normal property deals would clear the market in Q4. And in addition, these 4 bonds came out, which speaks to something about investors' interest in the risk and in growing the perils in the market. But I think that's an interesting point. Of all the times to pick, they picked a time when even the property deals we were at one point, I think the market was concerned, wouldn't clear in an orderly fashion.
Sure, and I guess that is a testament to the amount of work that goes in, and obviously, Alex, you in the cat space, data space, you must spend a lot of time with investors as well, or talking to managers and trying to educate them in how the reality of the SCS environment last year was in the States versus sort of what they could do to...
And I think last year was the perfect storm. And I mean it literally, because we didn't have a big cat event that could sidetrack the capital. And I think that helped the development of the cyber bonds. I think that helped, like Joe was saying, you've been educating the investors for the last 3 years, right? We've been having those discussions in educating the market even more than that. So there is a comfort level, you know? So I'm glad that we were close on the cyber side in having some sort of transactions done several times from 2020 to 2021. But there's always something that pulled it, whether it was Nat Cat event, whether it was a Ukraine event, whether something stifled it, right? But last year, it was the perfect storm in which everything aligned, rates as well. So pricing, like you mentioned, Joe, it was where it was supposed to be. So at that point, that's a fantastic point of view. Now, if you turn back to the Nat Cat area, its frequencies up. Like, I'm not going to go into the Ian conversation. However, that being said, there is more confidence even in the market. Yes, the market doesn't always like the number, but the environment right now, it's a little bit more transparent. It's a little bit more, I want to say, calm, as opposed to fluctuating up and down like a heartbeat, you know? So I think that helped put capacity. So I think into 2024, the ideal thing is it's gonna the deal flows that are gonna come are still gonna happen first part of the year, because there's the momentum going before something happens that will sidetrack it. And keep in mind, 2024 is an election year for a lot of areas, countries, geographical areas, and everything else. That usually cringes people. So that cringe could create capacity, withhold.
The opposite.
Yes. So I just some thoughts around it, you know?
Michael, flows, I mean, obviously cyber's not something that you guys are interested in at the moment, but flows in the cat space. I mean, are you obviously you're seeing interest, and I know there's a lot of sort of beauty parades with large investors at the moment, which is very positive to see. But do you feel the money is coming with a real desire to see the market environment sustained? Or is the money coming with an awareness that if it comes in, it's going to have to accept a rate that's lower in the future because that's the natural progress?
Well, I guess that's also down back to educating investors. And I think what we of course, and if I say we, I guess I speak for many ILS managers, we're looking for mid to long-term investors. And we're not looking for investors that look at one specific year like 2023 and say, okay, that's my expectation, let's move in now. And that's how much I'm going to clip for the next years to come. So it's really on us to educate investors what the average level of return over a certain cycle can be in this space, and what the duration of the allocation, the minimum duration should be, which in my view is at least 36 months, if not more, in order to really capture the value and to survive a bit of a volatility. The challenge that we have in our market is, again, is the lag, and that's of course the reason for the whole cycle, it's the lag. Especially institutional investors take a long time to get to an allocation. It's easier for an existing investor to upsize. It's hard for a new investor to come in. You discuss the topic and the asset class with one individual at an organization. That one individual is not necessarily the one that is taking the ultimate decision. It will be elevated to a committee, to a group of decision makers. At best, you get a chance to present to them. There could be beauty contests to it, and eventually there will be an allocation. So the negative element is this takes time. This takes time, and we, of course, need to make sure that we manage expectations. The good thing about it is, once the allocation has been concluded, especially large institutional investors, they also tend not to take rash decisions. So even if then there is a bit of a hiccup, i.e. there is a mid-sized or a larger cat event and maybe performance is seeing a bit of a dent at one point, doesn't necessarily mean that they exit, because again, it's not the one individual that has taken the decision. It has to be played up to board level. And I think one of the reasons why we have seen a bit of an exit of allocations within Europe is really down to the multiple years, as Mike mentioned, the multiple years of increased volatility that some institutional investors ultimately decided that this is probably not the right point in time to keep allocating, and now it just takes time to entice more and additional money.
Do you think there's too much focus on price and not enough perhaps on the terms and conditions sometimes? Because the first question I always get is are rates going to go down? That's pretty much the first question I get from any investor, I suppose. But is the
They both moved, and there was a noticeable shift toward occurrence from aggregates.
Yeah.
Which there should be, because severity has worked a lot better than frequency for the past half decade.
Mm-hmm. And do you think that leaves gaps for potential new products?
Same thing I said before. There's one nice thing is there's room. You know, even if high layers get crowded, there's a lot of room for endeavor.
Yeah.
It's not easy, and right now, you know, the pricing is kind of crazy, but there's room for structural solutions, because primary companies did not have a great year. I saw a statistic, Travelers, Hartford, and Allstate all had more cats through the end of the third quarter in 23 than they did in 22, more cat losses.
Yeah.
So that's an opportunity.
Perhaps no surprise they've all bought more out the top as well, because they can't get what they really, really want as well.
They also need to buy more at the top. I mean, the inflation's still not done, and they certainly didn't buy enough last year. There is still catch-up to play at the top as well as in the bottom. So there is going to be some, yes, there'll be supply. There is still some demand to balance that. There'll be a softening, but there is still stuff to be done. And on the aggregate side, I mean, that just models very badly using, no offense, the traditional model.
It was never as good, and it really showed.
And it's been, I mean, it's a strong word, it may be exploited in the past. And so we just need to figure out how to model that frequency better. And then it's a matter of structuring and if the price works. But it's really getting a handle on how you model that frequency, I think, is the weakest link so far in the chain.
Because demand is definitely rising still, and it seems there's a lag there as well behind inflation with the insurers. They're buying more cover now, even though inflation has potentially peaked. That seems to be a very positive thing for the cat bond market for the next 12 months, perhaps, because there's more being bought up in the higher layers, do you think? Where cat bonds are perhaps more efficient?
Well, I think that's always been the case in the past. It's also where the capital market is originally moved in and where it's coming from. Maybe on the frequency, I may have a slightly different view on that. We feel that there is capital protection and there's earnings protection, and there's a gray area in between. we certainly don't want to get involved in earnings protection. That's a business risk that insurance companies have to take to a certain degree. And then the gray area, how you define that, where do you set the trigger, how do you really get your hands around that? I also agree that frequency covers could be attractive covers also for us if we get our hands around where it should sit and when it should pay out. We're currently still hesitant to, again, shift back into the space. So the focus is really on top, and I agree that inflation is helping us. Yeah. Should not be quoted on this, but it's helping us because it really means that some insurance companies need to buy more on the top. What we see, however, and what's a bit of a concern to us, we're far away. Sitting in Europe, the US is the dominating market where the risk is coming from. What we hear and see when we talk to cedents in the US is that they, of course, have a different solution to the challenge. They can just simply non-renew policies. And you've mentioned the election process. So I'm thinking, okay, there could be some political potential here for a bit of a challenge if private individuals are unable to find protection.
Not only that, but some actual insurers are moving from catastrophe-prone state areas. So at that point, who's going to fill in that gap for the missing capacity, right? So.
Was the residual state pools, right? And so
yeah,
we'll see them coming to our market, no doubt, for the protection. So
there does seem to be more and more discussion of residual sort of pooling of risk again. One of the subjects I thought we could talk about perhaps is like pricing difference between private and cat bonds, and whether we think that is getting closer with better information flow and transparency, which I know is something this industry has always worked to try and improve and enhance, or whether we think that's potentially actually getting a bit wider again at the moment.
Well, one of the comments I have to make here is that I think there's at times a bit of a misconception. We're seeing, all else being equal, we're currently, of course, seeing that the cap bond pricing is a bit under pressure vis-a-vis the short-term sort of 12-month trade. But that's exactly my point. In the current market environment, I think that's also where the pricing should be, because if you now lock in your price for a cap bond for 3 years, you'll have to pay that coupon for 3 years at that level. And if you anticipate that the market is softening, you are willing to pay a bit more for a 12 months deal. And on our end, it's now difficult to, where do we want to sit in terms of maturity structure within our portfolios? We haven't made up our mind, quite frankly. We're having a huge discussion within our team. Some tend to say, well, this is the peak of the pricing, even for cap bonds. Let's go in and buy as much bonds as possible and lock this in. Others will say, but look at the same deal is paying 10, 15% more than the cap bond. Yeah, it's only for 12 months, but who knows what's going to happen next year? So let's lock this in for this year. And so there is no straightforward answer to this, from our end at least. For now.
Anybody else have an opinion on pricing differential between collateralized or private? No?
I mean, the traditional and collateralized markets price, really very close together, often in the same layers. They're really different markets because most collateralized reinsurance sits below most cat bonds. They're generally not pricing the same layers of risk.
Sure.
That's why cat bonds have radically outperformed. The past 7 years, with the exception of Ian, none of the events has topped 30 billion.
Yeah.
And so it has been a horrendous time for middle-sized events. There were $10 billion plus events in every year, except 2019. But there weren't as many severe ones, so the cat bonds didn't get hit as much.
When it comes to sort of the relative attraction that investors have at the moment for different products, obviously cat bonds are incredibly attractive at the moment to certain types of investors. Are you seeing, Mike, looking at you, are you seeing interest in other products? I know you've always
other
had
sectors
a focus on life and...
There's other sectors are having a completely different experience. This is a wonderful time in the life insurance sector. The life insurance sector is going through a massive transition where the traditional life insurance industry and the asset management industry are merging. There are all sorts of transactions that are generated in the course of that's on the scale of a collision of galaxies. At this point, $1 trillion of North American life insurance general account balance sheet is run by alt asset managers. Blackstone, KKR, 1 trillion out of 5.4 trillion. That number was close to 0 at the turn of the century. We think it'll be 2 trillion by 2030. And so there's a lot of heat and light that's emitted when galaxies collide, and you're seeing it here. And it's priced well.
Yeah.
Cyber is exciting. So there are a lot of interesting areas in the industry. There are areas of concern, casualty, for example. But Cat had a wonderful year.
Yes, yeah. And it's very interesting to see the life space at the moment. I think there is an interesting number of structures that people are working with. What are you looking at Fermat as sort of beyond
New
cyber?
New stuff?
Is there anything else? Because you are new markets.
I am new market. And I knew I was going to get asked that question, Steve. So yeah, cyber obviously I think is new. It's exciting. I think that is probably something that will grow the most rapidly. Casualty I know has come up a few times. Hard market and casualty right now. We're actually looking at it. That's the best time to look at it, when it's in a hard cycle. It's potentially interesting. Rates are up, also making that more interesting than before. So it's something we're looking at. Different, obviously, from CAT, but you have to look at both the asset and the liability side. But that's something that we're looking at. And I think actually weather. So as you probably know, you know very well, Steve, we've known each other for 25 years. I started my career in the energy weather derivatives market. It's the market that really hasn't grown. But I think as the new climate disclosures are coming on corporates, and I think there's a transition in energy to net zero. We have much more renewable generation now than we had in the past, and not as much not much base load as we had. Then there is a real need for a financial product there, which a weather derivative can fit quite well for energy companies, and that will take some time, but I think that could become relevant for our space eventually, solving those problems, very real problems that the energy sector is having, dealing with intermittency of the new types of energy supply. So those are probably the three things that we're looking at Fermat: cyber, casualty, weather.
I'm glad you raised weather, because it does seem to be that technology is getting embedded into most corporations' processes around net zero and climate, which I think naturally leads them to be able to quantify their weather exposure a bit better, which ultimately has a knock-on effect for the cat market as well, because the better they get at measuring their internal exposures, the more risk is going to get insured ultimately. Any questions in the audience at all for these people on stage? It would be great to get you all involved. No.
Who wants to
Okay.
Same question earlier, so I don't want to bore people. So I'll give you the question, you can say if it's acceptable or not, which is...
I don't want to be the arbiter of acceptability of questions, but...
Same iteration of a previous question that I asked this morning to a different group. How do you feel generally from where you sit about the earthquake insurance market generally, and then more specifically parametric? Do you have feelings about it? And
we have no feelings. Of course, earthquake is not mandatory. We talk about the unicorn of cyber that's not really mandatory. Earthquake's not mandatory. So what's the take-up rate in California? 10%, is it? So I think it's dropping. And with the California earthquake authorities, they'll tell us the statistics.
I think it's like 11 or 12. Yeah, it's very, very low.
But like I think it's just around there. So lucky the take-up rate isn't 100%, because I don't think there's enough capacity in the market to deal with 100% capacity. But our ILS market, we are at Fermat are totally open to parametric earthquake. There's capacity there for it. The trouble is originating that risk in the first place and helping people to buy, and the affordability issue. But there is no problem with earthquake in the ILS market in terms of capacity.
Yeah, I worked on parametric re, and it always worries me. The problem with parametric earthquake structures is that you don't want to create a box that just misses a hypocenter, or where the hypocenter occurs in a part of the box that doesn't shake where you actually have the. So the basis risk is a worry. So we saw parametric earthquake bonds deviate into these bonds that have tracks that follow faults, but then you're at risk that you miss a fault. So there are, and then you could do spectral intensity. There are issues around using parametric for earthquake. There are good things. It's a great business interruption insurance mechanism, because BI is so hard to insure that you might as well use parametric. We did a parametric deal 20 years ago for the Vivendi, for Universal Studios, where the risk manager was asked, aren't you afraid of basis risk? And he said, well, it's 1991. It's 2001. I had the Northridge earthquake 7 years ago. I'm collecting my last claims. That's basis risk. So at least this one I can collect in 92 days. But I think that there's plenty of demand for earthquake in the ILS market. I think the issue is there's just not enough issuance.
Yeah. No, that's the thing. Bring it on. But origination is always the challenge. You're selling that product and getting it to a size where you can tap our market. But the limitation is not here.
Thank you.
Any other questions in the audience at all? Do you think there's any other peril segments where the limitation is actually the supply of risk, where ILS would have plenty of demand for?
Oh, no, that happens all the time.
Yeah.
Origination is the issue all the time.
No, this market is about peaks.
Yeah.
So there's all sorts of perils in the world that would be lovely ILS, Colombian earthquake, Italian earthquake, Taiwan windstorm. But it turns out that those are diversifiable in the traditional reinsurance market. So the loads that you place on them are lower than the loads that are demanded, in our studio audience.
But even in the peaks, there's things to do.
In
Massive disaster gaps, massive protection gaps still exist in peaks. You just can't tap that risk. The vulnerable communities in Florida and Louisiana, lots to do. It just is structuring those deals, getting someone to pay for those deals, bringing these deals to market. That's always the issue.
I wanted to talk about Florida just quickly, because I think we spoke about Florida on the stage last year at the event. We had a session about Florida. I think you were actually involved in it, weren't you, Michael, last year? And certainly the outlook was that things were looking better, but there was a lack of conviction, I suppose, at the time that any issues had been solved yet. How are you feeling this year about sort of the 2024 renewals in Florida? Do you think anything has yet been proven out, or are we still another year or two from really seeing whether the legislation has helped there?
So I guess on our end, there's two drivers of our sort of Florida appetite for 2024. The first one is the fact that we've now engaged in interesting discussions with our investors in turn, and became apparent that an event like Hurricane Ian is a type of event where even our investors will be comfortable in actually allocating, even though it didn't hit us, it didn't affect us. It would not be an event where they would have been sort of surprised if we would have reported negative results. And so that supports our view that we can actually deploy more in Florida for 2024, because just in terms of risk appetite, in terms of risk tolerance, there seems to be an increased risk tolerance for that type of risk. And then to your question, we are seeing, and of course, again, we're sitting further back, we're gathering information from within the market, we're talking to local carriers, but we are seeing a significant improvement, surprisingly positive improvement in how the losses have developed. As a matter of fact, one company even confirmed to us that currently it seems to be rather difficult for certain individuals to buy insurance. Yes, you may end up with the insurer of last resort, but you may not want that. And so what you try to do, you try to be a good client. You try to behave. You try to pay your premium on time. You try to not upset your insurer, which means that we have been told that there is a reduction in what they call nuisance cases, where you just don't want to report the case, even though you could claim a certain recovery, but you don't want to upset your insurer. So overall, it seems that the tide has turned a bit, and the people start to behave a bit more. And so overall, the signals that we're receiving out of the Florida market, and again, we're sitting far away, literally, physically far away. But what we're hearing, what we're seeing, there seems to be a strong improvement. But the first point is, I think, more important for us, the fact that our investors seem to have an increased risk tolerance and risk appetite for that type of risk. So we are working towards increasing, not like we're not doing anything rash, but we are increasing allocation to Florida for 2024.
Okay, that's interesting.
The legislation was a lifesaver for Florida.
Yeah.
I mean, it was necessary, and it was done. And one-way attorney fees was taken off the table, and the impacts are meaningful and they are real. And that's exciting to see. And to Michael's point, there's also been a change of behavior, it appears, at the policy holder level, how juries take these cases, judges that are there. So that bodes well in the long run for Florida. We're very happy to have seen the legislative steps that were taken. It was required.
Okay, that's very positive as well. Mike?
It was our perception after that after 04, 05, that you made more money in homeowners than you did in CAT. Because CAT, you had elevated rates for 2 years, but the homeowners had elevated rates for a decade. And actually, there are 4 public homeowners companies in Florida, and I don't know if people were watching, but those 4 companies had a 120% appreciation in market cap last year, from Jan 1 to Dec 31, 23, excuse me, not 22. So the market certainly agreed, and we still, we had a herd of homeowners investments in Florida, which we had to cull at a certain point. But we still have some that we treasure. And they did see a decline in door knocking, a decline in new litigation. The legislature grandfathered litigation for Ian as a farewell kiss to the tort bar, which is unfortunate. But there's also been rate on rate. So Florida rates are probably 75+% higher than they were at the start of the hurricane cycle. So it's interesting. It's an interesting market again.
And the alignment's probably better as well, is it, between the primary insurers there and ILS and reinsurers, now that we have a new reality of attachment points?
The alignment is better. The alignment is better because there's less reinsurance available. There's co-participation here and there. A lot of the lower layers, a lot of the area below the CAT fund is now being reinsured through structured arrangements or in captives. So primary insurers care deeply about the quality of their underwriting.
Yeah.
There were, by the end of the long, soft market in 2017, hurricanes were a reinsurance problem. Primary companies were reinsured, above a tiny retention, 100% all the way up. They don't have that luxury now.
Yeah. Yeah, you don't really see towers with 1 million, 2 million, 3 million retention at the bottom. It was pretty crazy when you look back. Alex, anything to add on Florida from?
Yeah, actually, so I'll dive in a little bit on Ian, just because boots on the ground from what we've seen from the loss development as a result of like what you've mentioned, Mike. It's been seen as a level of claims that was initially associated with Ian hasn't actually spiked like the other time. It's actually tempered off. Yes, the actual insurers are like, okay, still conservative, still watching the environment, the litigations associated with it. However, they're not so concerned that, oh my God, it's gonna blow up the entire book because I haven't actually properly reserved it, So that's tempering off. Where it's gonna land, I have no idea. I think I saw a very good article not too long ago on take-up rates in Florida, and everyone was saying that legislation does have an effect. So even within the PCS realm and everything, we aim to say, hey, you know what? There's not going to be as much debate going forward. There's improved environment. So.
There are some dangers. The legislature is entertaining notions of not allowing people to cancel and move. And if companies can't move, it's going to be hard for companies to take up new business if they know that they can never exit it.
Yeah.
We saw that happen in some other southeastern states. But we're in a much better place than we were 24 months ago.
Sure. Any questions in the audience at all?
So one of the
microphone.
Yeah.
over here.
Ah.
So one of the latest innovations in the ILS space are things like tokenized ILWs. I think Assurance Plus also has a tokenized reinsurance product. How do you see that affecting the market?
I would just say I don't even know what that means. Mike, I'm sure you know.
I think you mean crypto denominated?
That's right. I think Hudson was just involved in that.
We're pretty nascent still. So there are a number of startup firms that are seeking to develop both crypto-denominated policies and insurance of crypto. Those are two separate activities. That's still very nascent. It's interesting. I mean, the Bitcoin economy is $1 trillion economy. So you would think that it would start to develop some insurance elements.
Yeah, I think where that's most interesting is probably around the plumbing that financial technology could turn into with the help of some of the developments within the crypto space.
And there are other issues in crypto. You've got to create, it forces you into secondary issues that are really interesting. It forces you to develop real lending in crypto so that you can have term interest rates in order to nourish a policy. It forces you to think harder about custody. So it's interesting, but this is a very, very, very tiny startup space still. But it has some interesting elements. You know, it isn't as though life insurance companies are finding it, you know, easy as pie to attract sort of young tech-forward customers, but this might be a pathway.
And to that effect, PCS has been actually asked to see what can be done on an index basis, because like you said, it's an education from the market perspective. However, once you do a parametric or an ILW type, it's easier to do it on an index deal. A service provider at that point, PCS, is easy to, okay, this is what it is. It's just about the nature of the investment to understand the tokenized part of it, the technology behind it, the mechanism that actually pay out, the actual flows of premium that come out of that. So it's still new in the market. It's still something that needs to be developed. However, it's there, and people are talking more about it. You know. So yeah.
I think that maybe for BIT or ETH, life insurance policies exist at this moment, at least that I know of. So we're early days.
Anybody on stage, your technology teams experimenting with AI yet, and how that can help your businesses? Too early still.
So I'm gonna take this one just a little bit. So internally, PCS, yes, Verisk has actually pushed out AI within the claims environment. I think just this week, if memory serves me, they've pushed out some stuff on the PCS side of the house, with the fact that we're not just NatCat, but specialty lines as well, within development and tracking of individual losses, risk losses, whether we're talking cyber, whether we're talking large losses and something like that. Yes, we're looking into seeing how can that be actually utilized in tracking, elevating claims monitoring and impactful from the event. So yes, that is something that PCS and broader Verisk is looking into.
Okay. Such a hot topic in most industries, but not quite yet in insurance. There we go.
So not all modern financial engineering has to be via crypto. In equity and bond markets, there are listed derivatives for stocks and bonds. Is there any chance for listed ILWs and other things? Or is exchange-traded cat bonds the end-all of that and everything else is private?
You kind of saved yourself, because the answer was no. You said the one thing. So yeah, the problem is that I've worked with this sector now for almost 30 years. And over that time have worked with at least 20 different entrepreneurs that were going to start an exchange-traded market in this risk. And we don't have one. And there's a reason. Because you've got to understand the nature of liquidity. The nature of liquidity is that every morning, lots of different people wake up who know about the value of an instrument, who have views on the value of that instrument, not all of which are the same, and who have the resources and empowerment to trade that instrument. So that's true for treasuries, that's true for currencies, that's true for billion-dollar-plus corporate bonds, which was why they're called benchmark bonds. That is absolutely not true for layer 3 of a Florida specialist homeowners insurance that has 3 reinsurers and a little tiny cat bond in it, most of which bonds don't trade. Like you can put it on exchange, it doesn't matter, it's not going to trade because it doesn't make sense for more than 4 investors to wake up knowing anything at all about it because it's just not big enough. But I said you saved yourself because maybe someday we could trade like the 20 and the $40 billion ILW. Maybe. But I kind of think that you have to think hard about liquidity when you're addressing this, because there's no magic. It isn't like the Wizard of Oz where by giving a testimonial you make something liquid. Liquidity is very inherent. It's got to be big enough, and a lot of people have to care about it, and not all in exactly the same way, and they have to be empowered. And that's when you have liquidity.
But that being said, Mike, there's other potential areas like marine, right? That you're actually looking at some derivatives that can actually be more.
No, but there are two different things. Derivatives are one thing, and that's wonderful, but the question is whether they gain anything from being exchange traded. There are lots of things that are listed in the world that never trade. They're not liquid. But it's like the Cowardly Lion's testimonial, or the Tin Man's testimonial. You can say it's liquid. It's not liquid. There are bonds. There are real bonds in the real world that are illiquid. There are 22,000 muni issuers in the United States, municipal bond issuers. They all issue, the town of Fairfield, like West Virginia, issues bonds for their sewer system, and it's $13 million of this. That's not liquid. There are like two people that know about that. They could maybe wake up and trade with each other. It doesn't make it liquid. You can list it, but it doesn't matter. Liquidity is an inherent property. It's not something that you wrap around something to turn it into gold. Sorry to rant about this. I've listened to. I've entertained that question every year since about 1994. It's a good one.
So where does the Chicago Board of Fire stand? Because
there were 4 different options created on the Chicago Board of Trade under ISO in 1995.
Yeah.
They petered on for about 2 years, and then they stopped because they weren't liquid.
So you're thinking that even now the same problem will happen if it got done again?
The way to think of it is this. This is the theory I'm postulating. It's not a law, it's a theory, so it's entirely likely I'm wrong, and we'll exchange trade everything in 5 years. But what I'm saying is anything that is standardized and big enough to be liquid is likely to create so much basis risk for protection buyers that they don't want to buy it that way. And anything that protection buyers want to buy is so specialized, it's unlikely to be big and standardized enough to be liquid. So where you bridge that is it may be that a few big benchmark ILWs could achieve real trading volume. Maybe. That'd be worth a try, I think.
There appears to be a general reluctance in the industry to underwrite ag risk and more attritional layers, that despite demand from primaries on it. Is it the panel's view that that type of risk is underpriced, or that the margin for error for a risk of that nature is just, there's not enough of a buffer in current pricing to really make it worthwhile? And if so, what are kind of the frictions that prevent pricing from calibrating to a level where the market is more willing to underwrite that risk?
So I've already sort of shared my view on that in the first panel. As I said, from our point of view, there is a difference between earnings protection and capital protection, and some of the frequency challenges for an insurance company may in fact be extremely painful for that company and may even lead to a very, very difficult situation whereby the CAT providers are not exposed at all because nothing happened at that level. And so within that gray zone of earnings protection and capital protection, there is, of course, a room to play. It's a bit of a challenge to price it, but if the price tag is big enough, then, of course, it's easily absorbable for the market. My view is that such sort of volatility covers are probably better placed in quota share structures, where you say, okay, I can see that there is an issue. There could be an issue with volatility. Could even be linked to climate change. In a certain region, you may see more events. Europe was battered with events last summer. In Italy, for Generali, it was an extremely difficult year. And so where you say, okay, then let's do it differently. You reduce your net retention because we cut off part of your entire portfolio. And we'll just take 10% of your entire portfolio, and we share. We take 10% of the premium and pay 10% of the losses. And then there's just a question, okay, are we benefiting from the CAP program or not as a quota share investor? And then I believe you can efficiently structure a solution which really works and which totally mitigates the discussion around the right price. Because then it's really business case. I say, okay, I'm a co-investor in this portfolio. I trust you, and you take a huge chunk, and you keep a huge chunk on your own portfolio anyway, so there's a proper alignment of interest. That's the best way to go about it.
I think Kapil has a question.
Thanks. I know you all said good things about the Florida market and recent legislative changes. So if everything good is happening and people talked about additional capacity, how much additional capacity do you think is available for the Florida market because of inflation, population move, and growth in Florida? So what do you think? What does the panelists think?
How much do you need?
5-10 billion? I know, Michael, we talked about it. So you can bring a checkbook, but in general, how much capacity you think is there more this year than last year or 2022?
Well, the aggregate capacity in capital markets, CAT, has been bumping along, reached about $100 billion at year-end 2017, and it's stabilized at about that level since. So since that, and it's, I think, 106. And actually, the keeper of that number is Steve Evans. So he is the most reliable keeper of that number on Earth.
Thanks, Mike.
So that grew from 0 in 1996 to 106 billion today. And I think you're asking what that number could potentially be. It could potentially be much higher. Like, I think that the constraint is not on the capital side. The constraint is on the market side.
Is it?
What about?
There's no constraint on more Florida risk capital for the capital markets. Again, like the earthquake question, it's just, is there more limit to be bought in Florida? And, are we comfortable that the legislative changes have had the effect that have been desired? There's been the behavioral change, the structural changes. We discussed that. I think it's there. I can't tell you what the market inflows are, but there is no, assuming those things are all aligned, then yes, Florida, already half of the market supports Florida, and it can happily support more.
Okay.
Yeah, in the scheme of things, a $100 billion market is still a boutique within the capital markets. The U.S. residential mortgage market is $10 trillion, to give you, so it's 2 orders of magnitude larger. And that's not a market that the capital markets particularly love. It's got irregular repayments. It's got all sorts of issues. The capital markets actually is fond of CAT when it's properly priced because it's diversifying. So if there was $1 trillion of risk to place
that was well priced,
and structured,
it could be placed.
It could be placed within the context of $100 trillion global capital markets, but there isn't.
Yeah.
And you'd need plenty of signaling of that risk coming to give you time to raise the money to actually absorb it, which is the other problem, because
it takes time.
Maybe Citizens isn't ready to signpost how much it could bring, and can the market actually bring the capital that's needed quickly enough to satisfy the cedent's need, I suppose. It's a bit of an issue sometimes.
Steve, I wanted to offer some, I was storing up observations today. I wanted to offer, because this was a fun conference, because first of all, there was a little bit of Back to the Future in it. Like, I was talking with one of my old timer friends who was saying, oh, it's a different generation, because I didn't recognize everybody. And actually, what I noticed is it really is. There are multiple people in the audience, and I won't name them, who are children of people who also worked in the ILS market. I worked on an early cat bond, so first of all, that makes me truly old. But second of all, I'm not sure I thought I'd see that. Second of all, what fun. What fun to see Evelyn and Bernd laying down the law on fees in the first panel. That's the way to begin. That's a great way to begin a conference. I liked to see that. Third of all, this is absolutely the first cat bond conference I've been to where we talked about extraterrestrial objects. That was
true.
I know.
Unmanned.
I mean, other people have been to more conferences, but yeah, extraterrestrial objects in a cat bond conference is a fun addition. We have to talk more about that. Fourth.
There was a conversation about asteroid mining earlier as well. So
yeah, no, I participated.
There's a lot going on.
That's interesting. There is a whole space insurance discipline. Meanwhile, there are people who do that. Brittany, describing herself in the cyber panel as an actuary at heart set me off. First of all, Brittany is actually a real actuary, so I don't know why she described herself as an actuary at heart, but I was like, I'm not an actuary, but it's like, well, am I an actuary in the sheets? I'm a fighter in the streets and an actuary in the sheets. Fifth, we had that discussion of the geography of capacity, which was mind expanding. Apparently, every remaining investment committee in Switzerland is so tainted by climate change that no more allocations there. Whereas in Australia, they're wide open. So I'm going to go home and draw a heat map and buy plane tickets.
Yeah, visit to Australia.
This was a great conference.
I'm glad you enjoyed it. We've got time for another question if people have them. We can go on for a few more minutes, or we can draw it to a close and all enjoy a cocktail. Nope? Okay. Well, look, thank you very much to panelists. Thank you to moderators for your hard work through today. Thank you to guests. Thank you to the other speakers, and thank you to you as well. Thanks for coming.